Great to have Hsu and Vitali Kalesnik with us today to talk about their paper on what is quality. Very cool paper. Glad that it's been published now in the Financial Analyst Journal. I think it's very well needed. There's a lot of confusion, especially amongst investors, when they talk and think about quality investing. What inspired the research? Maybe, Jason, would you like to kind of give a few points on?
Yeah, when Vitali and I, embark on a new research idea, oftentimes it's not because we're just totally insightful and creative. It's actually because we work with really insightful people. We talk to asset owners, we talk to consultants, and they would ask us. And one of the questions we're getting, say about 3 years ago, was, does quality as a factor work? That was kind of the thing that was really in vogue. Now, it was difficult to answer that question for Vitali and myself because, we don't know what people mean when they say quality. I think some people meant, quality of accounting, right? This is a firm whose numbers all add up, look right, or is this quality of the management team? Maybe it's quality of the business, right? Does it have really good margin, growing business? And without really knowing, it was impossible to answer that question. So we decided to do a comprehensive research that just basically put the whole kitchen sink, right? Any definition of quality that we have read about, heard about, we put it in there and just did a comprehensive survey.
We looked at it from the perspective of fact investing, and we know of a few problems common in fact investing, so data mining being one of them. Quality, particularly not being very well defined and meaning different things to different people, was a big challenge because it is, by being ill-defined, it gives just way too much opportunity to data mine. And so that's why systematically understanding what do people understand by quality, and then looking at robustness of some of these metrics in terms of their ability to generate return, I think that's the core contribution of this article.
And when you did the research, so what quality definitions would you say were robust? What generated a premium?
A few quality definitions that we found to be the most robust were related to profitability, investments, maybe conservative accounting, and conservative issuance policies. As I'm listing this, actually maybe those ones familiar with academic literature will recognize that actually these are areas that have seen quite a bit of academic research, even though that quality is not an academic term, but there are articles published on profitability, articles published on conservative investments, conservative issuance, conservative accounting practices. So these, not surprising, these academically inspired or academically studied definitions have shown to be the most robust in terms of generating return and being more of valuable quality definitions.
Yeah, and as you can see, these four quality factors aren't really the same thing, right? So you might say they all point to some sort of quality, but it's hard to say they are proxying for the same firm attributes, same kind of behavioral mistakes being made. And so I think it's just really cleaner to see them as separate effects that work. So if you think about profitability, oftentimes, and Vitali will give you lots of examples where profitable companies actually, what do they look like? They look like firms that have healthy margin, that have really a great economic moat, right? They're kind of boring, they're still growing, but are probably beyond that initial super explosive phase, so they're not sexy, they're not interesting anymore. They're not what you think of as a 10-bagger. That's what people are looking for when they're buying growth. So in some ways, these are the growth at reasonable price. And then, that makes sense why that could be sort of a investment characteristic that could lead to better return. You look at, say, conservative investments. This is really about CEOs who, despite the fact that they have cash sitting around, they can raise more cash, right? They got strong earnings in a quality business. They show a lot of constraint in reinvesting that money. So they don't have this empire-building desire. They don't have the issue of money burning a hole in their pocket. They don't waste investor money. And again, that kind of constraint is actually really, really rare, and it signals high-quality management. And so these things do make sense, and they've been well studied in the corporate finance literature. And so there's a really good understanding why these attributes and what the mechanism for outperformance is.
So Vitali, Jason mentioned the high profitability companies. Maybe can you give a few examples of some of those?
Yeah, so companies that tend to get picked up by the profitability and a few other accounting quality metrics, like conservative investments, for example. The examples of companies tend to be companies with strong moats, companies like ExxonMobil, for example, or companies with strong consumer brands like Pepsi-Cola or Coca-Cola. These are the companies which have been there for a very long time, which have their steady stream of cash flows because the profit margins are protected. ExxonMobil has a very strong infrastructure which is very hard to replicate. Coca-Cola, Pepsi-Cola are a collection of brands and they own trademarks on them, and that guarantees their profits over long periods. These companies, when you especially look at other elements related to conservative governance, these variables tend to make sure that management doesn't squander. Management doesn't go and build their pet projects, doesn't buy jets, and instead returns this money to the investors. And so this conservative investment, for example, from that perspective, tends to be a very good proxy for that. And so these are the type of companies that get picked up by these valuation metrics.
Do you find that there's a link with quality investing and ESG or responsible investing?
Definitely. What Vitali and I found, right, despite the fact that these are really different attributes, some about management, some perhaps about dividend policy, issuance policy. If you really want to string them together, you could summarize, instead of calling them quality, I think the ones we found that work may be more related to governance, right? So the G within ESG, and I think, whether it's management constraint, whether it's, management not trying to time market an issue when the stock price is expensive to take advantage of sort of new shareholders. These all, I would say, fall under the governance label, and certainly I think there's a reason to believe in this case why governance could be beneficial. And certainly I think these factors, especially in emerging markets where governance is particularly an issue, where regulators perhaps aren't as on ball in terms of dealing with these issues, these factors do particularly well.
It's interesting to just point out a few examples just pointing from your ESG perspective conversation question. Example, what is the type of company that you would avoid with these type of screens? Well, companies like Tesla, for example. Tesla is not really profitable. And Tesla is doing great investments. I mean, Elon Musk is a fantastic marketer. A big fan of Elon Musk. But I think many of the things that he does are targeted towards more bring attention to the company and selling the great story around it. So how much did drilling, we haven't seen tunnels under LA yet, or we haven't shot a rocket to Mars, and there is no colony on Mars yet, but it's really fascinating. And when it draws attention, it drives up the price of Tesla and makes it easy for Elon Musk to build an empire. And so these type of examples where there is unchecked CEO potentially engaged in an empire building, this is not necessarily the best type of governance. And so it's then not surprising that we see a few scandals from time to time around Elon Musk and governance-related questions. And so that's where this ESG dimension is probably, and the governance G part of it is probably the most, the strongest. And the other piece, important piece, is that ESG is very topical. There is a lot of talk about ESG, a lot of attention to ESG. There is not all that much academic research. And these financial discipline-related metrics, in my opinion at least, are a few where we have pretty strong evidence and economic theory why they could be associated with better performance. And so that provides a potential for investors to marry the ESG considerations with the desire to generate better return.
Interesting. So we talked quite a lot about the good quality definitions, the robust ones. Can you mention anything about the duds? Those that didn't work, that have been used quite a lot in our practitioner community?
There are definitely a lot that didn't work. I'll just offer one. For example, so some people call it the quality of the capital structure. Yeah. Essentially, there's a claim that firms are very geared, very leveraged. Those are bad quality firms. But if you think about it, U.S. is a very efficient financial market. Like banks in the U.S. have been doing this for a very, very long time. Debt buyers, very sophisticated, maybe more sophisticated than equity buyers. If they're willing to lend you money, that means you got strong cash flow. You got hard assets in place. If they don't lend you money, it's usually because you got some software IP, you're not generating cash flow. You certainly have nothing that you could pledge as hard asset, so you can't debt finance. So the capital structure, amount of debt you have on your book, more is not less healthy, more is not low quality, more is in equilibrium exactly what you deserve. And so capital structure is one thing we found. There's not such a thing as, less debt is higher quality firm, therefore higher return. We just don't see that.
And even by economic theory, Modigliani and Miller would argue that more leverage makes you riskier and you should earn higher return. And so it's not that all that surprising that when we, so you can tell one side of the story, but you can completely tell the opposite story, that when we get the data, that idea to the test, we don't see any pattern in terms of performance. The other examples of metrics used in some quality definitions are earnings growth or earnings stability. And growth-related metrics tend to be already priced in by the time when you see the growth in earnings. Because the frequency of information release is actually quite low. So by the time when you incorporate that information, the earnings surprises are already in the prices and you're kind of on the later wave of reacting to them. So it's not that all that's surprising that it's that we don't see performance. But and one more important piece, the fact that we see quite a few quality definitions that are not robust is an important piece in itself. I think that draws a point that looking at factor definitions, how it's defined, it's important to do quite a bit of scrutiny. There is just way too much incentives and possibility for data mining. And specifically within quality, it's the greatest, and so investors should be paying attention to that.
That's very interesting. So just on that last point, any kind of parting words of wisdom for investors out there that are interested in quality investing, things that they should just watch out for going forward? Maybe Jason, if you have any kind of last thoughts on that.
Yeah, so maybe it's disappointing for many, but the quality definition we found are actually things that are well understood in the academic literature. There's a, long and thriving corporate finance literature that explains why things like, concerted issuance, concerted investments, things like profitability, these lead to better outcome. And the other sort of sexier innovations, interesting concepts don't really pan out, aren't all that robust. So, it's once again, the really rigorous research, they tend to be persistent over time in terms of driving returns. A lot of the bells and whistles that sort of sex up for product sales appeal tend to perhaps be sort of more fluff than actually useful. So that would be my advice to investors. Really do pay attention to robustness of the sort of factor attributes. It's useful to look at, hey, if there are 5 different definitions, they'd only pick one that had the best back test. What are they hiding from you? So that's really useful to ask, really useful to think about.
These quality definitions, they have inherent element, so especially when they're combined, of quality at reasonable price, because profitability together with some conservative governance-related metrics brings more likely to bring good performing companies which are not in the spotlight. But even with that general tendency, you're never guaranteed that category will not get mispriced, because there is no natural price anchor there. So if a company has good profitability and is conservatively governed, it's not true that it will generate return at any price. So building in some element of price check is very important. So specifically today, for example, we see that profitability-related metrics tend to be expensive relative to its own history. And so I would say watch out. Going forward, profitability may disappoint you, at least in the short term. So building into the process some value component can significantly mitigate this risk.
Great. Well, thank you both very much for having this conversation with us. And again, thank you, Jason and Vitali, for talking at the Investment Symposium in London.
Thanks, Joe.